Welcome to the Broken Pie Chart Podcast, episode 361. I'm your host, Derek Moore. Back with me again is Mike Snyder and Shane Skinner. All right, lots to talk about this week from the markets. Apparently, we are not invading Greenland. More on that later with some of the market stuff we saw this week. Shane, you were at a conference in Chicago this week for a day, and I thought we'd start there. Because obviously more and more people are using options. We know we're, sort of an option-centric advisor and sub-advisor and asset manager. But I don't know. I mean, what are some of the highlights that you heard? We know it's growing. Let's not bury the headline.
Absolutely. I mean, the main takeaway was 2025 was a record-breaking year, marking the sixth consecutive year for record-breaking numbers in U.S. listed options. So it's not that we're seeing random growth out of nowhere. We're seeing like steady, continued growth in this market. Options are continuing to be used in a variety of manners, right? Some speculative, some hedging, some to create more efficient use of capital, right? And so the main sort of takeaway was there is probably going to be continued growth in listings, I think, on like equity zero DTE stuff or more weekly listings. I think both SIBO and NASDAQ have said that's coming this year from some individual stock names, right? I think there's an argument that makes the market way more efficient because the more expiration dates there are, the better. You might be able to phrase this better than I can, but the more of the term structure that can be traded, the more it tends to smoothen. Is that correct, would you say? Like volatility might actually go down because of that?
I don't know. I mean, there's different parts of the curve, but I can tell you, I remember the days when you only had a monthly expiration. So in other words, let's say it was 30 days out to the first one, 60 days to the second. And if you had to roll positions, adjust positions, it's not like now where you can go from a Tuesday to a Friday, and certainly in the SPX or SPY, things like that. So it probably, it definitely gives people more choices. Does it dampen volatility at all? I don't know, because the volatility, as we know, is still the expectations of the underlying. I think it's not surprising, and you had pointed out the SIBO posted. This is from Henry Schwartz at the SIBO State of the Options Industry 2025. Record-breaking growth, 6th consecutive record year for U.S. listed options. Shane, I think I see 61 million contracts.
Yep.
Daily traded average 61 million contracts a day. Is that right?
Yes, a day. That's not the annual number. That's a day. Yeah. And it's the biggest takeaway again. It's growing. Look at the zero DTE info. I mean, zero DTE expiry SPX options average 2.3 million contracts daily and comprised of 59% of the product's total volume.
Wait, say that again, because if it's 2.3 million contracts daily and there's 61 million contracts traded,
how
to
much?
Me, if I do the math, that's like 3.8% of the volume.
Yeah, 3.7, 3.8. Yeah. So not only are you seeing the zero DTEs and SPX making up almost 60, right, 59% of the product's total volume on a daily basis. It's again, like you just said, it's making up over 3.5% of the entire option market's daily volume. I mean, I don't know. These numbers are nuts. Like, I don't think Mike and I were talking about this stuff this morning, and it's just incredible how vast, how quick this is growing, and they just continue to make more and more things available. It's not slowing down and it's not contracting. It doesn't seem like. Would you agree, Mike?
Yeah, I mean, from like 2010 to 2019, it was, pretty consistent volume, and then it just took off in 2020. And I think a lot of people, me being one of them, just sort of thought it was the environment that everyone was in, and the volatility because of COVID, and people looking for something else to do, trading more options. But that wasn't the case, and it seems like it was just the beginning of options exploding, really. Um, yeah, I mean, I would love to know how your average retail investor is using them, especially these zero DTE options. Sort of what their strategies are. I think it's interesting how much it's continued to grow.
Mike, don't you think though? I mean, we sort of have. I mean, there's the expirations, and you remember it used to be when you had just the monthlies. Expiration day was a big deal. Now with a lot of products, you have a daily expiration. So although you have zero DTE, which in theory is the ones that expire today, this afternoon, like yeah, those are traded, but I wonder how many of those are just people closing, rolling. They're not necessarily trading those. I don't know if SIBO has that info, but like Mike, look at the chart too, the annual options volume. And it's tough to see because really 73, you go to like 99. You see that big jump in '07. And I think what you're finding here is when the retail trader had the ability to trade online, and that really is, I mean, that's like 97, right? It starts to jump. You get the jump in '08, '09, '07. And then it was 2019, really the jump.
Your phone,
Yep.
it really started to become like you could do this on your phone. Yeah, it's access to markets, right? It's just as access to markets has expanded and become more, I guess, efficient or easier to do. It's just gone parabolic
I mean,
almost.
there's also more and more ETFs. And as you have more
Those
ETFs,
are, yep.
you have more options on ETFs. So, it doesn't surprise me. It is interesting though that like I was thinking about this, and Mike, you can chime in. They've tried, especially with futures, to do single stock futures. Those never really took off. Futures are a different animal. It's people trade futures. You have to think about the contract specifications where standardized options contracts, for the most part, are the same unless you have splits or some mergers or those types of things. But I mean, futures never really took off in the way that I think a lot of people expected it to, Mike.
I, I like you said, I think it's a little bit more complex. I think the single stock, if you're just trading on the underlying, you sort of, it doesn't take a lot more math to sort of figure out your risk and the contract size and all of that. So I think that may have been a barrier, just the complexity of it.
Shane, I know you were at the conference. You were talking to a lot of people. Anything else sort of just jump out in
Yeah.
conversations, things you saw?
Yeah, so there were two other areas I wanted to just briefly mention. I'll stick with the option space first, real quick, and I think you guys might have something to be able to say about this flex options, right? And if you look at the average daily options volume by product type, look at flex options down at the bottom. I know it's really easy to focus on, that single stock names and ETF and
Mm.
index sort of lead the charge here, but flex option usage is growing significantly. I didn't know that flexes existed since 1993. I didn't know that. Um, so this isn't like this is something that's brand new. I just think that, and maybe this goes back to what you said earlier, Derek, ETFs usage of options and the sort of creativeness of the market to come up with these different strategies, both on the institutional and the retail side. You're seeing flexes kind of growing.
Let me interject here for a second. And a lot of the audience may not know what flexes are. So flexes are, we use these at times if they make sense, but we could through we're a registered investment advisor, uh, custodians who hold the assets like Schwab, Fidelity, but then they have institutional trading desk. And the institutional trading desk can create almost an option for you. And ETFs use these, mutual funds may use them, but you see them in ETFs. And the thing with the flex is they could create something that doesn't exist, meaning an expiration that doesn't exist, maybe a 5 year. I think some of them can even go 10. I won't get into the mechanics of how many market makers do or don't offer those. But the benefit of a flex, if it's appropriate in the situation, you turn an option that is an American style option, which means in theory it could be assigned anytime up to and through expiration, to a European style where whether it's Apple or Google or any of these, they are European style then. They don't have the early assignment and they price a little different. So what we've seen too is our ability to use these. It used to be the minimums were really, really high. And some of the audience might remember in the movie The Big Short, they talked about a firm being able to create options, or they needed an ISDA agreement. And I think Mike, you might remember this. Warren Buffett, I believe in 2008, he probably went to one of the investment banks and said, I want, a 10 or a 15-year option. I don't remember exactly what it was. I think he was selling puts on some of the markets. So do you remember that, Mike?
Yeah, he's doing it on banks, right?
It might have been. Was that what it was? Okay. So, but I think it's a good point to bring up because, like, what if the ability to create flex options becomes more widely available and available not only to institutions like us, but to retail. So you're right. I mean, it's tough to see. It would be interesting to see that chart just on its own, Shane, to get the scale. But it looks like
Chart to the right, annual growth.
Yeah.
10-year annual growth rate's 32.5%, 5 years 53.8, yep, 1 year 61.9. So it is a product itself is growing. And again, it's more institutional space, but it'll be interesting to continue to observe that and see how many more people find their demand met via the customization, or not to be punny, but the flexibility, right, of flex options.
Yeah.
That also flows into the other big topic, which I don't know how you guys feel about these. I haven't really brought it up much. I know we've used some of the data from some of those sites, and I think it's an interesting topic, right? The concept of prediction markets, right? And where Wall Street and investors and fund managers, portfolio managers, like, where do prediction markets add value or belong within this side?
What's the closest comparison, Shane? Is it a futures contract?
It's that, or it's a binary option, which, long story short, with a binary option, it's essentially you're betting on the outcome of something being this or that, either A or
people can't lose more than they put in. In other words,
right.
Yeah. So it's not like a future exactly, but something's like a 0 to 100 price, I think is the way they do it. Right.
Yeah.
And then, so if you think, let's say something is priced at 90, which has a high probability of happening. So you buy it at 90, the most you can make is 10 there. And I actually don't advocate doing any of this. I'll get to that. But if you want to go against that, and I'll just call it a bet, because it's kind of what it is.
Yeah.
You could short it at 90, and if it doesn't happen, you make from 90 to 0. But I don't.
It's a spread, and you can trade the spread. You can trade the pure event, hold it all the way through expiration, and again, you're either 100. Are
the exchanges going to do that? Like, are these going to be regulated products?
Absolutely. So I brought the question.
Who is this good for?
Okay, so where there's argument of added value is, but I know there's a counter to this, and I know you will mention it. So, like, Fed funds rate, or what Powell will do, or something economic related, jobs data. Like, the idea is that with the ability to place predictions on the outcome of economic data, et cetera, you have the ability to potentially better price out expectations. There are people that made the argument, hey, these expectations are already sort of drawn out anyways prior to, without any products to necessarily bet on all of them or invest or whatever. So there's both sides of it, right? The argument as well was like there might be the potential to hedge risk using these, depending on how you can sort of cross the correlation or relation. It's almost like beta weighting, right? Or delta weighting, I guess.
All right, look, I think, all right, I may have a different opinion of this. What I will say is in political circles, people made the argument that prediction models are a better indicator because people are actually putting money towards
Correct.
their opinion. And the polls have gotten some stuff wrong. Prediction markets have gotten some stuff right. I think sometimes what people miss the mark in is how much volume is actually in. I'm just going to say, like, the idea of a 25-year-old kid logging into his whatever, Schwab, Fidelity, Robin, it doesn't matter what it is, and then basically betting. And I don't know.
They don't want to
I don't know
bet
who
on
needs that.
Taylor Swift's dress color at her next concert. And what I mean by that is that's no offense to Taylor Swift or her dress color. The point that was
But
made.
didn't the guy, one guy during the earnings thing, there was a prediction market thing of what he would say during the earnings call, and at the end he goes, "Oh, and one more thing," and he rattles off all those terms.
I brought that up. So look, you're seeing it on White House conference times. You're seeing it on, like you just said, you're seeing it on what people are going to say during an NFL game. The broadcasters, right? And we all know broadcasters, right, read off of a teleprompter. So I didn't bring it up in the middle of the meeting. I'm not going to Big Short in the middle of a conference and stand up in the middle of a panel and say something. But I did talk to one of the gentlemen that was on the panel and privately. And I just said, what do you think about the issue of transparency or sort of being able to fix certain things? And he said that realistically, they're not nearly as interested in that stuff as they are, again, focusing on stuff like binary events, earnings outcomes, things of that nature that they can sort of, but I don't know. I'm with you. I don't like it. And I
don't know who needs this. Like,
there's a lot of griping in the crowd. Again, whether this takes off or not, they're probably going to test the waters. And you brought it up earlier in this single stock future. Tried it. It didn't work. So
yeah, nobody really wanted it. All right, Mike, before we get to you wanting to become the president of Greenland, we've got plenty of material on that. Any thoughts on prediction markets?
No, sort of like what you said. I think what it would result in is mostly speculation and gambling. I think if there's someone who's looking at these being like, I can use this as a way to protect my portfolio because if this event happens, then I would expect this to happen in the market. I think there's instruments already available where you can do that. I don't think adding these is necessary. I think it's interesting to look at to see where people think a certain event may land, but I don't think it's necessary or needs to be involved. I think any use case you can really think of for these, I think you can already accomplish with existing investment strategies.
I mean, yeah, like let's say you wanted to make a direct bet investment, I'll call it a bet for now, on whether, I don't know, CPI is greater or less than 2.7 annualized year over year. Okay, so that's a direct thing on that. Or you could try and put a position on because you believe it's going to be some number and that will have the outcome. The difference is you're putting something against the direct outcome, not the resulting behavior of the market. So, all right, Mike, start with you. Greenland. I can't believe the market sold off because Did it really think the U.S. was going to like invade Greenland? I think this whole thing was Trump he wanted whatever sliver of land this is, have some bases up there. But Mike, did the market just seriously sell off 2% the one day, and it lasted a day?
I'm kind of surprised it fell for it again. I mean, how many times have we seen this now where something is announced and almost immediately walked back after the market sells off? I mean, it's been a handful of times now. There's an acronym for it already. It's TACO, which people have been saying, which Trump always chickens out. There's a Wikipedia page for it, actually.
Did he chicken out, or did he just, this was his outcome he wanted all the time, and he
That's
bargains
the
hard and
question.
then comes back? Yeah.
Right. Is he asking for a lot, knowing he's not going to get all of it, and negotiating towards something in the middle, or is he chickening out? I don't know. But either way, this has happened a number of times now, and every time it's been a buying opportunity.
You know, it's funny too, because a long-term investor, it is irrelevant what happened on, what day was that? Wednesday? Is that just Wednesday?
I think Tuesday.
Was it Tuesday? We had the holiday, so my week's kind of screwed up. But yeah, like it's irrelevant what happened on a single day. And you know, I look at the bond market too, specifically high yield. And you guys have heard me say this on our, trading chat that we have. Who's wrong? High yield or the market? And I was like, the market's down 2%. High yield is down, I think it was down, 0.3%. And Mike, my answer is like, okay, who's wrong? Because if it was a real problem, normally high yield is going to be more closely correlated to equities, right?
Yeah, you would think so. Typically, like during the the initial tariff announcements and big sell-offs, you usually see them a little bit more correlated. These short-term one-day blips, we've seen some separation recently.
Shane, the other thing we watch, of course, is volatility. I mean, did we get a volatility pop? I mean, I guess we hit
cracked 20 barely, and then we're right back down to 16 handle now.
I mean, it says the high was, the close that day was 26. No, that's November. I'm sorry.
VIX barely cracked 20.
2009. Yeah. Not much.
Yeah. Yeah. So, volatility isn't always good. I think people sometimes misunderstand volatility though, because sometimes it's an opportunity, right? And it can be good for investors. I think you're right in that short-term little pops like this one, if you are a day trader or someone that is, trading the front end on futures, big movements like this in the market, whether it's index or VIX, if you're trading that's significant. Where this provides opportunity for investors is if you did decide, hey, this looks oversold relative to where I think it should be, and you step up, you buy a little here. You're happy with where it's at now. But I'm with you guys. I think this is typical. Over sensationalizing some of the things that are said, or people taking him for his exact word when in reality, again, it's saying I want the whole thing and then really only wanting a sliver. And if you get the sliver, mission accomplished. So
I'm looking. Yeah, no, I think that's right. And we got to talk about gold, probably talk about silver.
Yes. We got to, minerals, right? That's a big part of the.
Well, here's what's interesting. You look at a chart. So I'm looking at GLD, it's obviously gold ETF from State Street. One of the, I think that was the first one. I remember talking to George Milling Stanley, who was involved in creating that. I had lunch with him one day. Very pleasant gentleman. Enjoyed kind of hearing some of the backstory behind it and everything. But, you look at that, it gaps up when the market was down. And then immediately everyone's like, oh, that's going to sell off. No. It sold off the next day, but now 1, 2, 3, fourth day, another all-time high, 458.75. I haven't checked the spot price of gold, but it's probably just south of 4,600. People are saying now, does gold just keep running? Like when, and we even said, not a lot of people were asking us about gold. Like normally when you have these things that are going on, you start to get calls, at least I do, saying, hey, maybe we should add gold. And look, we have different allocations to gold in some of our strategies. We have a strategy that has gold equities and treasuries, kind of efficient capital, stacked, whatever you want to call it, but we create leverage there with synthetics. So we've had gold in these portfolios. But like Shane, you look at gold, here's the thing. If you're trying to play a home game, this is really, really hard. Wouldn't the most obvious thing to be, once the market's recovered and we're not invading Greenland, gold sells off? And you made the point, like, is this cyclical, secular? I don't know where gold's going to be. I'll let you know in 6 months. But there's part of me that says like retail is not even hitting this yet.
No. And looking at on a yearly basis, looking at gold, right? Last big run up we had, like multi-year, was 2005 to 2012. Peaked technically in 2011. And I mean, it sort of feels like gold's really not taken off here much for past 3 years, maybe. So
I mean, it went up, it based, and then it's in the upstage again.
I'm hearing a growing sentiment for the concept that or metals can continue to run and the market still hold. And it's funny. It seems like we're just seeing records are meant to be broken, right? But like between both of your guys' careers, how many records in the market, have been shattered, or abnormal things have almost become normalized? It's just one of those things where I don't know. I don't know what to make of it.
I mean, it's more buyers than sellers. Mike, I mean, silver's the other one. And we've talked before. If you look at charts of silver, like very long-term charts, it sort of does nothing. And then you have these spikes. Like you never know when the spikes are going to happen. But there's been serious spikes several times. Like look at a monthly chart on silver. Like that's a parabolic move. And it just made another new high today, right?
It did. Yep. It was up another 6%. I mean, I wonder if, silver, people are looking at gold and saying, okay, gold has run. What's something, cheaper that I can buy more of that maybe has more upside? But yeah, I mean, it hit up another almost 7% today. It seems like gold, I think at the base, a lot of people would say gold is an inflation hedge, and it clearly, I think, is a lot more than just that. The way it has run,
it's funny. Do you think it's delayed though? Like during 2022, wasn't it only up like 1.5% when we had inflation? Like it's almost like
right.
We had inflation. It's time for me to go up.
It could be. It could be a lagging. Sort of a lagging rally for it. It's
look at I've never even looked at this ETF before, but Global X copper miners. So not copper directly, but COPX. That chart looks like, look at a monthly chart on that. It looks like silver. So it's not just gold and silver. It's kind of the metals complex.
I gotta call out the chart I just sent to you both.
Oh, you sent us charts. I like charts. What do you got?
TLT. So this is yearlies, right? Candles. Mm-hmm. TLT.
Okay, yearly charts. So every candle's 1 year. Right?
Every candle's 1 year.
Okay,
going
that's
back
a long-term chart.
Oh yeah. And ironically, it's great fitting. Look when GLD starts and when TLT started. TLT was out 2 more years than GLD, so they both came out around the same time. look at that ratio and how wide that has gotten. We're also seeing TLT trading at levels early 2000s, mid 2000s. So this just makes, I don't know enough about the debt market as I would like to. I'm continuing to read about that side because it's
Okay. Well, thanks for your comments then, since you don't know. I'm
no.
kidding.
No. Where I'm going with that is, please, like, I want your take, Derek, on you know, what do you think of this? Like, this is pretty significant, but does it actually mean anything? Is
Well, I mean, look, it's
broader going on
the
dollar
longer
wise?
end of the curve is, I mean, there's definitely a correlation between growth expectations and the longer end of the curve. If you look at a trailing 10-year period, the yield on the 10-year treasury and nominal GDP growth, not the inflation adjusted. So I think some of this is there's some expectations for both nominal and real GDP growth. And it's just how onshoring, exports, imports, the whole thing. I mean, there's some people think that we could have GDP of 6% next year. And if you think you're going to get growth like that, you think the long end would reflect the growth. So, yeah, I mean, and we're not seeing inflate. The rate of change on inflation is not going up. We're not seeing that. But I mean, it almost looks like, I mean, here, I'll throw another one out to you guys. Let me see. PALL. I don't, these stickers I'm throwing out, like, please, these aren't recommendations. I just Googled like Palladium ETF. I haven't looked at the spot price of Palladium, but like
Oh,
Mike, look at PALL monthly chart. It's surging. Like, are they just buying anything metals? It's kind of like the early 90s. Everything from Mexico, Telefonos to whatever, Telefonos to Chile, Telefonos to Mexico. Everybody just bought those, right? Like,
Yeah,
was there some
if it
demand?
has
Like,
.com after it, you just buy it, that type of thing.
exactly, like copper, palladium. I'm trying to think of the other metals.
that ETF saw the highest volumes it's ever seen in a single year last year, and it's been around since 2010.
What other metals are we missing here? I mean, we don't have to do this on the spot. I'm trying to think. Not like, oh,
Platinum.
platinum. Yeah, hang on. Let me see if there's a platinum ETF.
I love this. I love where we've gone with this today. This is great.
Well, it's just all
It's
right.
relevant.
So
It's happening.
PPLT. So
TP.
same company. That's an ETF. Again, not a recommendation. I have no idea on this.
Wow, look at this.
Mike,
Wow.
what were we doing last year, Mike? I mean,
Parabolic.
where was that to start 2025? That ETF was at $83.50 roughly. It's at $252 right now. Whew.
So this is beyond, I think the exercise, and this is why I wanted to do this. It's not just gold. It's not just because inflation. It's not just silver. And it's the metals. Like, and this reminds me of the 80s when you'd have all, people wanted these metals mutual funds. And like, it's not just gold. Like, all this stuff is running. And this happens. Like, people are like, okay, I'm going to find the next metal that hasn't run yet, and I'm going to buy that one. I mean, maybe there's some sympathy. I know copper is one of the inputs in some of these AI, the data centers. So that's a thing. But yeah, like, apparently you just should have bought palladium, copper. What's the other one? Platinum, gold, and silver. You would have been like many multiples of returns.
If you can get to the future at some point, check out live cattle as well.
Oh no, we just lost the audience for
It's
live
great.
cattle.
It's great. I mean, but this is commodities, right? I mean, are we seeing a return to tangible, physical assets and investments, seeing more growth? I mean, I'm not saying the market's not going to go up this year, but if people start taking their money out of the market, it's going to have to go into other things, right?
All right, I'll call this one doesn't look like the other. I'm looking at live cattle. I can't believe you had me do this, but fine. I'm looking at live cattle future charts. I mean, it hasn't exceeded the high from October.
It's coming.
Well, no, don't make that prediction.
Well,
Don't
I'm not
tell people
making that prediction. I hope it doesn't happen, but
well, because your food's going to get more expensive.
I
Well,
know.
so that's part of it too. And let's triangulate back to inflation.
Yeah.
Like Mike, when you think about, okay, these are input cost. So does this show up in inflation? I mean, so far we haven't seen it. I mean, I guess it's rather new that these things are really spiking like this.
Yeah, I mean, maybe it shows up later on. I don't think we've seen it yet. I don't know. I mean, can you just say this group as a whole is a hedge against just global uncertainty? I don't even know.
Unwinding of supply chains or supply chain disruption, deglobalization. Everybody's sort of going into their own corner. Like physical, real assets mean more in that situation.
All right, look at ALUM. I think this is a aluminum. Like if aluminum's running, I'm going to be like, really? That doesn't. Okay, hang on. Well, look at Alcoa, AA. And yeah, Alcoa's been running. I don't know. I'd have to look at. Let me look at my futures on here.
I'm seeing a max. Yeah, I mean, I'm seeing we aren't quite back to the high of 2022, but it looks like we're trading at like 3,138. The high was up near around 3,500, and it's been pretty much straight up for the past about 6-7 months.
All right, so this is more than just gold, and I think what people here's kind of my take on what people should be thinking about here is if I'm not necessarily saying you do a trade, and look, if you're adding these things to a portfolio now, are you early, are you late? Well, you're not going to know until you know. We've had gold in portfolios. We thought it had a place, especially in some of the strategies that look for diversification in different pockets. But here's my take on this and what you should be watching and thinking about is, and Mike, I think, you touched on it a second ago. So is this the beginning or the end of the price moves in these? And a lot of people, I can't say I listen to a lot of aluminum talk or palladium talk, but a lot of people think gold has more to run. Maybe it does, maybe it doesn't. We'll know when we know. But I think, Mike, you look at, does it factor into inflation? Something to keep an eye on because these are inputs. And do we get the New York Times or the CBS Nightly News that does the story, the contrarian, where I'm going with this, the contrarian story where they talk about, people hoarding palladium or platinum or investors can't get enough of these ETFs. Like that's one of the things I think I'm watching for to see what happens here. Because we saw it with emerging market funds in the 90s. When you go into to get your TV repaired and the guy has a prospectus for the Merrill Lynch Dragon Fund emerging markets in his back pocket. Like that to me told me it was at the top. So I don't know. We'll see. Do you guys want to talk earnings at all? Can we do that?
Yeah.
Oh yeah.
All right. Mike, let me start with you. Let me go through for the audience a couple earnings next week. This is a big week. So let me just go through a couple names here. Microsoft, Meta, Tesla. Okay, little companies. I've heard of them. Good. Apple. So Microsoft, Meta, Tesla scheduled after the close on the 28th. Apple after the close on the 29th. There's a lot of people in here. Of course, like Boeing is in there. You've got Starbucks, ASML, AT&T. I'm just looking. There's a ton. IBM, Caterpillar, NASDAQ, SanDisk. SanDisk has been running. Visa, Chevron, and then the energy ones on Friday. So, like Mike, this is, and I'm going to look up the options too, but this is like a big deal because you get the biggest names reporting, and I don't know. Do they beat? Do they not beat? Does the market react well? What do you think?
You get some of the biggest names reporting, and it's interesting. I feel like for a long time we've gone into this earnings week, and it's the biggest names who have been outperforming the market. And in this case, you have some big names that are really beaten down while the market's still near its all-time highs. It feels a little different to me. I don't know what the options say yet, but I think we're in an environment right now where the market is, I think, much broader and stronger than it has been in a while. These earnings are very important, of course, because these are large companies and there's ripple effects. If Apple has poor earnings because of low phone sales, that means suppliers may feel that as well. So of course they're very important. But it'll be interesting with these stocks that have underperformed the broader market, how they're going to come out here.
Mike, you and I talk about Microsoft. Shane, we'll talk about Tesla. Mike, 47.5. No, 45 is the implied volatility. I'm looking at the 467.50 option for next Friday. So there's not an expiration, right on the 28th. So, I mean, that's not that high. And Mike, you normally, right before earnings, you'll see that pop up a little bit. So it's a little bit early, right?
Yeah, if you're buying and at the money right now, it's like an at the money call and an at the money put. That's like a 5% move you would need to break even. Feels a little low for Microsoft, but I don't think too far off.
I mean, we've said though, Mike, it's always the most important earnings season ever. Maybe it's just a dud. Maybe they're already pricing in what's there and it's a big nothing burger, right? So we'll see.
It always feels like it's the most important, and this week is the most important. And then once this week is over, Nvidia is the most important.
That's
and then
right.
It's over, and then the next one's the most important. I mean, they're all important, especially when you have a market that's run like it has at these valuations that it's at. You need these companies to come out and reinforce what we're paying to own the market here, right? Even if they come out and earnings are good, but maybe just the overall sentiment of the call or forward guidance is in line, not higher. Market could take a breather even with strong earnings.
Shane, for the audience, implied volatility a little higher on Tesla, 55. Felt like that would be higher, but it's still same comment. As you get closer, the implied volatility jumps. So what the implied move there based upon the volatility is, if I divide 15 or 55 divided by 15.875, 3.5. And then you pay what for the straddle at the money? It's what is that, 27, $28, Shane? So
yeah, about that. So you're talking 5%, roughly.
yeah, you
5%.
got to.
I think so. One, how do I even follow Mike up after that? He summarized this earnings season and everything.
So you're good. You don't have to talk
Right,
about.
right. No, no. It's look. I don't know if it's just become more normalized, or if it's just something I think I'm noticing. But I feel like the general trend in pricing earnings has been big names get anywhere from 5 to 10%. 5 seems to be normal. And it's going to be a wash of some names are going to be up or down 5 to 10 plus, some might be flat. And I think that the biggest thing about this earnings, Tesla being a huge contributor to this, is if the big names can, the ones that have been sliding continue to slide, and then the ones that have been holding up start sliding as well. I mean, yeah, what if the broader market does pull back, right?
What if everything else picks up the
if
slack?
everything else picks up the right. I mean, who knows, right? I'll tell you in a couple of weeks. But
But you should have bought Spain's market, and you should have bought like Palladium, apparently.
no. I mean, well, yeah, in hindsight.
By the way, Shane, Apple 37 implied volatility. I'm kind of cherry picking a strike because it's kind of in between the two strikes. Meta Did we talk about Meta? Its implied volatility is more like it's above 50, I think. Yeah, it's if I'm reading this right, was that 55, 53, 56? Okay. So, yeah, like Mike said, anywhere from 3 to 5%. I mean that's so all right, that's the big ones.
Do we know the trailing PE on Tesla?
I can certainly look it up.
I would like to know the trailing PE on Tesla and Apple, just because you assigned those to me. But Mike brought up the concept of like justifying what we are paying for in these names, and I know that this has been
Well, does trailing matter though? Like I always think that's already done.
it's
And
past, so it doesn't.
I will tell you to answer your question. According to Bloomberg, the trailing is 236.35 trailing PE, price to earnings. Next 4 quarters, 225 spot 43. So yeah, that's on a relative basis to the other companies. That's pretty high. You want to know Apple's? Let's look at Apple's PE trailing and forward. I can almost guarantee you, I shouldn't say that word, but I'll say it anyway, that it's going to be much lower than Tesla's.
Yeah.
But give me a second. I'm just hitting some keystrokes here. So Apple's trailing PE 33.2. The next 4 quarters, forward 12 months, 30.
Okay.
Does that tell you anything? Or
I guess the only thing I'm going to take away from that, and again, this ties back into Mike's concept of expectations and justifying valuations and whatnot. And that's, I think the market's expecting Tesla to grow significantly in the long run here.
Well, it'd have to be at that forward PE. I mean,
to Apple,
Microsoft is 28.
Yeah. So Tesla seems to be, of all the names, I don't have all the Mag 7 names here, but I would assume that of all 7 of them, maybe NVIDIA, I don't know. I doubt it. But Tesla seems to be the one that stands out in that class of.
Meta's 22.5 forward PE.
For NVIDIA?
No, Meta. NVIDIA. So here's kind of the way I think about this sometimes. Does Tesla have the most to lose at a bad earnings report? Because it's such. I mean, NVIDIA is 26.66 times forward. That's like Mike. That's not much compared to.
Yeah, I think Tesla certainly has the most to lose with that valuation. I think it would be easy to justify, selling that stock because it's trading, it's expensive, like you said, relative to other companies.
Or they kill earnings and there's an announcement.
Yeah. I think eventually they have to grow into that number. And
robo taxis, they've got to get more AI out. Yeah, exactly.
So I can't do it on the fly, but there is a concept called the reverse discounted cash flow. So discounted cash flow takes the future expected cash flows to the firm or to equity. And it basically says, what are you going to make? What's expected over the next couple years or 5 years? You have this growth period, and then you go into a terminal growth period. That's when the company matures and it becomes more like an older company, just growing with GDP. And so you can use those earnings estimates and those free cash flow estimates to come back to a discounted cash flow, discounting to the present value. But there's something called the reverse DCF, where you can actually see, based upon the price currently, like what the company would have to do in the future, like how much in earnings it would have to actually have to do. And I remember people doing this in the 90s, early 2000s for Cisco. And it was some ridiculous thing. And I wish I could find it. I would put it in the show notes. I don't know where it is. But there was this article and they talked about the CEO. I think it was the CEO once came out and was like, there's no way we can possibly back into this valuation that we have. Like he was even saying it's too high. So
Elon did the same thing. Didn't Elon years ago come out and say Tesla stock's too high? I don't know if he meant long run or in.
I don't know. I don't know if he got into the granulars, but so, if you told me ahead of time we'd be talking reverse discounted cash flow, I would have done one.
Oh, this would be great for next week, following up on the earnings.
I don't know if I'll do it next week, but yeah. So, all right, look, it's going to be an interesting week. Seems like Greenland is done. We'll move on to the next geopolitical thing for people to worry about. Big earnings week next week. But besides the bone-chilling cold, apparently a lot of the country is going to experience, not an issue here in Arizona. Shane, to you first. Any recommendations for the audience?
Yeah, I am going to go with... Oh, I had it here. Hang on.
We can come back to you. I can go to Mike.
Yeah, please come back.
Well,
all right, Mike.
Yeah, I mean, I don't have anything, but it's going to be like -30 here this weekend, so I should have enough for the next few weeks being stuck inside.
You don't go outside at -30? You too soft to do that? Like, it's too cold out? Yeah.
Yeah.
Right. So if the Bears would have won, they would have been hosting a playoff game at -30, huh?
No, because the Seahawks won. If the Seahawks lost and the Bears won, then yes, which would have been incredible to see.
Okay. Yeah, that would be a tough game to be at. All right, so no recommendations. I will tell you, I have nothing new, but the other night I was flipping through and a movie called Road to Perdition was on. Tom Hanks. I don't know if that was Paul Newman's last film, but Hanks and Newman are in it together. It's I like the movie. I think it's a classic movie, and seeing Newman and Hanks together is pretty cool. So Road to Perdition, it's probably on HBO or any number of places or one of those. So I know it's not a new movie. Like, I'm not breaking any news here, but have we talked about The Rip yet?
I think you said you were going to talk about it.
Okay. I liked it. I liked The Rip. So I watched that. Damon and Affleck together. I thought it was good. Like, it was a good use of my hour and 40 minutes, however long it was. So
if you're going to go,
I'd put a buy recommendation.
Okay, if you're going to go Road to Perdition, I'll throw out The Untouchables then.
Even older, yeah.
So good though. It's classic. And then I'll throw it out there in the season of it being freezing across half the country. Budgetbites.com chicken noodle soup recipe. It's fantastic. Making some tonight for my sick kid.
Have they paid us for a sponsorship? What's going on here?
They haven't, and I'm sorry.
Shane has a side deal with them.
I'm getting kicked.
Do not say that.
Prediction markets.
You have no side deals.
Yeah.
So who is this again? Budget soup. Who is this?
Budget Bites. Budget Bites. BYTES. It's just a website with a bunch of different free recipes. But they have a chicken noodle soup recipe on there that I use. It's great chicken noodle soup. I also was going to say I probably use 2 to 3 times the amount of garlic as it says too. That's just how I cook.
Okay.
But yeah.
So do you buy food at the site, or you go and they do recipes?
Recipe. Yeah. I mean, I need a good cookbook. I need you guys to come back with a recommendation on a good cookbook to buy, because
I don't know that I'm the person to recommend a cookbook. No, I probably not. But okay. Well, I think this company this site should send like a T-shirt along. I think they should.
They should
send that. Okay, I'm looking at the site. All right, so I see. Oh, okay. The prices on here are theoretically, if you got the ingredients, what it would cost you to make this.
Correct. And I think some of them are better than others, but realistically, like, I don't know if you guys are leftovers guys, but I'm a huge leftovers guys, meal planning, prepping.
This podcast is going off the rails quick, but go ahead.
Bad. So I'm going to stop with my recommending of food and please.
All right. We did it. Go Greenland, go whoever your sports team is, stay warm this weekend, or I guess this will be out once the weekend's almost all the way done. But Mike, no recommendations for things that have happened already? Or are you good this week?
The Indiana Hoosiers won the national championship. That has happened.
I did.
Shout out to them.
I did see that. Good for them. All right, everyone. I think we're done. Have a good weekend, or hope you had a good weekend, and we'll talk to everyone next week.